This is the headquarters of America's most innovative company. 7 years in a row, Wall Street called them geniuses. Fortune magazine called them completely untouchable. But behind these glass walls was a multi-billion-dollar theater production. Executives literally built fake trading floors and hired actors to pretend to buy and sell energy just to trick visiting investors. In August 2000, Enron hit a peak valuation of $90.75 per share. Less than 18 months later, that stock was worth 26 cents. $63.4 billion evaporated instantly. Most people look at Enron as a historical anomaly, a relic of ancient corporate greed. They are dead wrong. Enron wasn't a one-time glitch. It was a master blueprint. The exact same financial trapdoors, hidden debt loops, and system gaslighting methods are actively being deployed on Wall Street and digital crypto exchanges right now. To understand how the illusion worked, you have to look closely at Jeffrey Skilling's favorite financial weapon, mark-to-market accounting. Traditionally, if a company builds a power plant for $100 million, they record profits when that plant actually starts selling electricity to real customers. Simple, clean, and logical. But Skilling convinced federal regulators to let Enron use an accounting loophole that sounds like absolute madness. Think of it like this. Imagine you buy a single lottery ticket today. Instead of waiting for the weekend drawing, you sit down, calculate the theoretical probability of winning, and immediately declare yourself a multimillionaire on your personal balance sheet this afternoon. Enron would sign a 20-year contract to supply energy to a city. On day one, before a single wire was laid or a single watt of power was delivered, Enron's accountants would estimate the total profits they expected to make over the next 2 decades. They would book that entire imaginary number as pure, realized profit right then and there. If the project failed 2 years later and made $0, it didn't matter to the executives. Enron had already used that paper profit to pump its stock price, pay out millions in executive bonuses, and justify their next massive acquisition. But this created a terrifying systemic problem. Enron was reporting billions in earnings, but they had almost zero actual cash coming through the door to pay their bills. They were fundamentally broke, trapped on a valuation treadmill where they had to sign increasingly absurd, larger contracts just to pretend they were solvent. They were printing fake profits on the front page of their ledger, but on the back page, their real-world expenses and massive operating debts were piling up like a mountain of dynamite. They desperately needed a place to hide the bodies. Enter Chief Financial Officer Andrew Fastow and his brilliant, sinister creation, special purpose entities. Andrew Fastow realized that if Enron kept taking out massive bank loans to stay afloat, Wall Street would see the debt, downgrade their credit rating, and collapse the stock price. To bypass this, he built a global network of off-balance sheet shell companies, special purpose entities, or SPEs. They gave them mysterious names like Chuco, LJM, and Raptor. Imagine you have maxed out 10 different personal credit cards. To hide this from your mortgage lender, you create a legal entity under your child's name. You transfer all your debt to that child's account, and then tell the lender, "Look at my pristine bank statement. I have zero debt." Fastow took Enron's overvalued, mark-to-market inflated stock and used it as collateral to secure loans for these hidden shell companies. The shell companies took the cash, handed it back over to Enron under the guise of buying assets, and absorbed all of Enron's massive investment losses so the public would never see them. It gets even worse. Fastow didn't just run these shell companies for Enron, he privately owned them. He was effectively sitting on both sides of the negotiation table, buying assets from himself, hiding Enron's losses, and skimming tens of millions of dollars in personal management fees completely in secret. You might wonder where the gatekeepers were. Where were the independent auditors whose sole job is to protect public investors? Arthur Andersen, one of the elite Big Five accounting firms in the world, was pocketing $1 million a week from Enron. They didn't just look the other way, they actively helped build the architecture of the fraud. When the SEC finally launched an investigation, Arthur Andersen executives initiated an emergency protocol, shredding over 26,000 pounds of Enron accounting documents to wipe the forensic trail clean. But it was too late. The math always wins. The collapse happened with brutal, terrifying speed. In early 2001, short sellers and investigative journalists began pulling on the loose threads of Enron's public financial filings. They noticed a bizarre anomaly. For all of Enron's reported billions in net income, their actual cash flow from operations was completely hollow. In October 2001, the dam broke. Enron was forced to restate its earnings, revealing a massive $444 million third-quarter loss and wiping out over $1.2 billion in shareholder equity overnight. The hidden debt loop had ruptured. Panic hit the markets. Investors scrambled to dump their shares, sending the stock into a catastrophic terminal tailspin. On December 2, 2001, Enron officially filed for Chapter 11 bankruptcy protections. It was the largest corporate bankruptcy in American history up to that point. Thousands of ordinary employees lost their jobs, their health insurance, and their entire life savings stored in Enron stock options. Top executives were indicted on dozens of counts of conspiracy, insider trading, and securities fraud. Washington panicked. Congress rushed to pass the Sarbanes-Oxley Act, explicitly promising the public that these exact accounting trapdoors had been permanently sealed. But they lied. Fast forward to the modern era. When Sam Bankman-Fried's multi-billion-dollar crypto empire, FTX, imploded, commentators called it a completely unprecedented digital asset anomaly. Forensic accountants knew better. FTX was just Enron operating at internet speed. Look at the structural mechanics. Enron used off-balance sheet special-purpose entities to hide its massive losses and toxic debts. FTX used its closely linked sister trading firm, Alameda Research, as an off-balance sheet black box to quietly siphon off over $8 billion in customer deposits to cover bad bets. Enron used its own inflated stock to secure loans for its shell companies. FTX used FTT, a digital token they created out of thin air, fully controlled and arbitrarily valued as multi-billion-dollar collateral to backstop real-world liabilities. The playbook didn't change, only the technology did. Even in traditional public markets, the regulatory landscape remains highly volatile. The Public Company Accounting Oversight Board continues enforcing strict auditing standards like QC 1000 to combat systemic failures in corporate risk management. The gatekeepers are still losing the race against complex financial structures. The ultimate lesson of the Enron scandal isn't that bad actors get caught. It's that human financial systems are inherently vulnerable to the illusion of infinite growth. When an investment or a company becomes too complex for an ordinary investor to understand, the complexity isn't a feature, it's the mask. The next $60 billion loophole is already being exploited right now. You just haven't read the headline yet. If you want to protect your capital and stay ahead of the next major corporate collapse, make sure to hit that subscribe button and click the video on your screen right now to uncover the dark reality of modern shadow banking.